For 5,000 years, one metal has outlived every empire, every currency, every promise of a new financial order. Kings have hoarded it. Wars have been fought over it. Economists have ridiculed it as a barbarous relic. And yet, here we are, in the third decade of the 21st century, watching gold shatter record after record. This is the story of gold from the year 2000 to 2026. A story of fear, of power, of human folly, and of cycles that refuse to break. The year is 2000. The Nasdaq is screaming higher. Pets.com has just held its IPO. Alan Greenspan is the maestro of a seemingly endless boom. And gold? Gold is trading near $280 an ounce, close to a 20-year low. Central banks are dumping it. The Bank of England, in what would become known as Brown's Bottom, sells more than half of Britain's reserves at the worst possible price. The conventional wisdom is clear. In a digital age of productivity miracles, who needs a yellow rock? Then the bubble bursts. Trillions of dollars in market value evaporate. On a clear September morning in 2001, two towers fall in Lower Manhattan, and the post-Cold War illusion of a peaceful, frictionless globalization dies with them. Quietly, almost imperceptibly, gold begins to climb. 2003, American tanks roll into Baghdad. The Federal Reserve cuts interest rates to 1%, the lowest in a generation. The dollar weakens. Commodity prices surge. China, hungry for raw materials, becomes the workshop of the world, and a new commodity supercycle is born. In November 2004, a financial innovation changes everything. The SPDR Gold Shares ETF, ticker symbol GLD, launches in New York. Suddenly, any investor with a brokerage account can own gold with the click of a mouse. Demand explodes. By 2006, gold trades above $600. By mid-2007, it tops $700. The metal everyone had forgotten is back, and the smartest money on Wall Street is starting to whisper a single word: bubble. But the bubble they are worried about is not gold. It is housing. September 15, 2008. Lehman Brothers files for bankruptcy. The global financial system seizes. In the panic, gold actually drops, as leveraged hedge funds sell anything that is liquid to meet margin calls. It is a critical lesson. In a true crisis, even gold gets dumped first, before it soars. And soar it does. The Federal Reserve, under Ben Bernanke, launches quantitative easing, printing money on a scale never before attempted in peacetime. The European Central Bank follows. The Bank of England follows. Trillions of dollars in new liquidity flood the system. Gold breaks $1,000 in early 2009. It breaks $1,500 in 2011. And then, in August 2011, with Standard & Poor's downgrading United States debt for the first time in history, gold reaches its inflation-adjusted moment of glory, an all-time intraday high of approximately $1,920 an ounce. This is not just a price. It is a verdict. A verdict on fiat currencies. A verdict on political dysfunction in Washington. A verdict on the age of permanent stimulus. But every verdict can be appealed. In May 2013, Ben Bernanke utters one word that changes everything: taper. The Fed signals it will slow its bond purchases. The dollar strengthens. Real interest rates rise. And gold collapses. From peak to trough, it loses nearly 45% of its value. By December 2015, as the Fed finally raises rates for the first time in nearly a decade, gold bottoms near $1,050. The pundits declare the bull market dead. Goldman Sachs calls gold a slam dunk sell. Warren Buffett, as always, mocks the metal that just sits there. And yet, beneath the surface, something is shifting. China and Russia are quietly, methodically, buying. Year after year. Ton after ton. They are not speculating. They are preparing. 2016 brings two political earthquakes. Brexit in June. Donald Trump in November. Globalization, the doctrine that had defined a generation, suddenly has powerful enemies. Tariffs return. Supply chains, once optimized for efficiency, are now being redesigned for security. By 2018, the United States and China are locked in an open trade war. Then, in early 2020, a virus from Wuhan brings the global economy to a standstill. Governments unleash fiscal stimulus on a scale that dwarfs even the 2008 response. Central banks expand their balance sheets by trillions in mere weeks. Real yields plunge deep into negative territory. And gold, sensing the moment, surges to a new all-time high above $2,075 an ounce in August 2020. It is a stunning rally. But it is only the warm-up act. In February 2022, Russian tanks cross into Ukraine. Within days, the United States and its allies do something unprecedented. They freeze roughly $300 billion of Russian central bank reserves held in Western financial institutions. Overnight, every central banker in the non-Western world receives the same chilling message: your dollar reserves are not really yours. They are a privilege, revocable at any moment, for political reasons. The reaction is immediate and historic. Central banks, led by China, Russia, Turkey, India, Poland, Singapore, begin buying gold at the fastest pace in over 50 years. In 2022, 2023, and 2024, official sector purchases exceed 1,000 tons each year, more than double the previous decade's average. The BRICS bloc expands. Trade settlement in non-dollar currencies accelerates. The phrase de-dollarization, once a fringe idea, enters the mainstream. Gold responds. It breaks 2,500 in 2024. Then 2,700. Then 2,800. The Federal Reserve, after the most aggressive hiking cycle in 40 years, begins cutting rates in late 2024. Inflation remains stubborn. Sovereign debt swells past $36 trillion in the United States alone. Every traditional valuation model for gold is broken, and gold keeps climbing. 2025 is the year the world stops pretending. A new round of trade wars erupts. Tariff threats fly between Washington, Beijing, and Brussels. Confidence in long-dated U.S. Treasuries wavers. Gold, almost casually, breaks $3,000 an ounce in the spring. Then $3,200. Then, in a stunning summer rally, it touches roughly $3,500, an all-time high, in nominal terms, and within striking distance of its inflation-adjusted 1980 peak. What is driving this? Three forces, all pulling in the same direction. First, central banks remain net buyers, structurally, year after year. Second, Western retail and institutional investors, after a decade of indifference, finally rediscover gold ETFs. And third, a deeper, almost philosophical force, a growing recognition that the post-1971 experiment of pure fiat money may be entering a new and uncertain chapter. So what comes next? Here at the threshold of 2026, three plausible scenarios stand before us. The bullish case. A mild global recession forces the Federal Reserve into deeper rate cuts. Real yields turn sharply negative. De-dollarization accelerates as more nations settle trade outside the dollar system. In this world, gold could plausibly trade toward $4,000 to $4,200 an ounce. The base case. Inflation remains sticky around 3%. Geopolitical tension simmers without exploding. Central banks continue their methodical accumulation. In this world, gold consolidates, then grinds higher, toward roughly $3,700 by year-end. The bearish case. A surprising geopolitical détente emerges. The dollar strengthens. Risk assets rally hard, and capital rotates out of safe havens. In this world, gold could correct sharply, retesting $2,900 or even lower, a painful, but historically normal, mid-cycle pullback. step back, and the pattern becomes clear. Gold's great bull markets are not random. They emerge when trust in the monetary order erodes. The 1970s, after Nixon closed the gold window. The 2000s, after the dot-com bust and the war on terror. The 2020s, after the pandemic and the weaponization of the dollar. Each era believed it was unique. Each era was, in fact, repeating an ancient script. Empires overextend. Debts compound. Currencies are debased to paper over political failures. And gold, patient, indifferent, eternal, quietly reasserts its role as the final settlement asset of human civilization. The numbers on your screen are not just prices. They are a measure of confidence. Or rather, the lack of it. From $280 in the year 2000 to perhaps $4,000 in 2026, gold's journey is not really a story about gold. It is a story about us, about the choices we make, the debts we accumulate, and the trust we slowly, inevitably, squander. History does not repeat itself. But, as Mark Twain reminded us, it certainly rhymes. And in the rhyme of gold, we hear the oldest song humanity has ever sung. Thank you for watching.